Index funds represent an asset class that could not be ignored when it comes to wealth creation. And when we talk about indexing as a strategy, it has to do with investing in a typical index funds, a fund that tracks the overall performance of a given index. So in this video, I'm going to talk about what is called direct indexing. Direct indexing, which tends to represent the future of personalized investing. And so direct investing or direct indexing actually is an investment strategy that allows individual investors to directly own the underlying securities of an index. They own the underlying stocks or securities of an index rather than investing in the index fund or the mutual fund or the exchange traded funds that tracks the index. Instead of owning these asset classes, one may choose to invest directly in a given index. This approach enables customization and control over the portfolio while aiming to replicate the performance of a chosen index. That's how it works. Instead of buying into a given index fund, you choose to rather invest in the companies or the stocks that constitutes the index. So you invest directly in the stocks that makes up the index instead of investing in the index, or the indices itself, as the case may be. So let's look at key features of direct indexing. Important features of direct indexing. Number one is customization. Investors can tailor their portfolios by excluding certain stocks based on probably one's value, and based on certain ESG preferences or criteria, or overweighing others to reflect personal values or investment goals. You may choose to put in more funds into a given stock or stocks to reflect your personal preference in this instance. Number two is tax efficiency. Through tax loss harvesting, investors can sell individual securities at a loss to offset gains elsewhere, potentially reducing their overall tax liabilities. That could be done. You sell a losing stock that will not attract any tax to offset the other ones you sold that attracted them taxes. Number three is cost effectiveness. Cost effectiveness with fractional shares and commission-free trading offered by many platforms. Direct indexing has become accessible to even retail investors. You discover that there is fractional ownership. In the case where the stock price is so big, is so high that you can't afford to buy a single share. So you could then buy, a fraction of a unit of the shares. That's what is called fractional ownership. And of course, it is done in a cost-effective manner. So retail investors could afford to do that, to direct index without incurring much cost. Even in a case where they can't even afford a particular stock, they can key in through the avenue of fractional ownership. Number four is diversification. Diversification. Like exchange traded funds and mutual funds. Direct indexing provides exposure to the broad market, to to almost the entire market or sector, while allowing a kind of granular control over your investments. So you have that element of control compared to simply buying an index. So you can choose what to buy and what not to buy, amongst the stocks that constitutes a given index. Number five is personalization. Personalization. So investors can align their portfolios with their specific values or preference, as the case may be, and preferences, such as excluding industries like maybe fossil fuel, maybe tobacco or alcohol, or companies and in the defense space. You have that particular control over the nature of investment you want to get involved in. You kind of like personalize your investments. Let's look at the advantages. So a key advantage is that there's greater flexibility compared to traditional index funds. For instance, now I appreciate maybe the Nigerian All Share Index, or maybe the S&P 500 in the US, and I wouldn't like to invest in breweries. Okay, so I can employ the avenue of direct indexing, buy into stocks that constitute the index, but exclude stocks that don't really meet my personal criteria. So that's a typical advantage of this particular strategy. The second one is it enhances opportunities for tax management. You know how to manage your taxes. You could employ a tax loss harvesting. You sell shares at a loss, so as to be able to balance or to augment for the ones the taxes you've paid, and the ones you sold at a profit, to kind of counteract your capital gain taxes. Not only that, there's a potential for better alignment with personal or ethical value. You could align your investment with your personal values, with your ethical values, as the case may be. You set your priorities aright, investment that could meet your ethical priorities. Then let's look at the challenges or the disadvantages involved in this strategy. It requires more active management and monitoring. You have to actively manage and monitor your portfolio. So you have to buy, and at the same time you need to sell whenever the need arises. You have to be involved actively in managing the portfolio. Not only that, it may involve higher administrative costs, especially for smaller portfolios. When you start buying individual stocks, you discover that there's admin charges will kick in, and these fees will end up eating into your profit at the end of the day. And it's not suitable for all investors, particularly those seeking simplicity. If you want simplicity, it's not suitable for you. You want to simply go and buy your index fund, your mutual fund, or your exchange traded fund. You just prioritize simplicity. You don't want what we call wahala in Nigeria. This particular strategy is not for you. So direct indexing is increasingly popular due to advancement in technology and investment platforms that makes it accessible to individual investors. With your smartphone and your apps, your investment apps, you can very easily adopt this particular strategy. You buy stocks in the index that constitute the index, and you could do that even at the comfort of your home. So it's particularly appealing for those with specific financial goals or a strong focus on tax management and ESG factors. If you're so keen about impact investing, then of course this particular strategy is something you could take into consideration as an investor.